Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Part of our concern now is that the U.S. stock market fall and the U.S. dollar starts taking on all this risk, given the amount of public debt that the U.S. government, becoming the stimulator of last resort, has created in here, and the systemic risk may be flowing to the U.S. So that's part of what this is showing us at the moment, this change in correlation, both negative at the same time, both positive. But what again we can't square is the fact that if the U.S. consumer falls out of bed, there's systemic global risk. There's just too much dependence still on the U.S. consumer. So we still cling to our story that if the U.S. gets in trouble, the other players, China and Europe, will get in more trouble, and sooner or later we'll see a risk bid back in the U.S. dollar. And I say clinging to the story because it is a story until it becomes hindsight. This is a chart, interesting chart. I told you about the valuation squeeze. This just shows the black line is the euro-U.S. dollar currency pair, and we know the story there. 160, big plunge, credit crunch, just got clobbered, rally back up, shaking a lot of people out, then a plunge on concern about the Eurozone. The euro may go away. Now it's been rallying up in a nice little correction. The red line is the euro against the Chinese currency, and you can see that it moves very, very tightly with the euro-U.S. dollar, and that's because the Chinese currency is pegged to the U.S. dollar, so we would expect this, although it's appreciated somewhat, and you can see that the euro-Chinese low is much lower than the euro-U.S. dollar low in here. But in effect, if you think of Europe, you think of their exporters, their currency is going up, and even in these rallies, on a relative basis, their exports are getting, on a price advantage basis, are losing out to its two biggest competitors, the U.S. And China. This is another reason that we just don't think this can last, and the Eurozone can get out of the box that it's in. They need currency help here. They need some relief on the currency. So we expect this dynamic to change, and it's one of the reasons we think this move in the euro, besides all the other background contingents and the concern about the European banking system, which probably will be whitewashed with the stress tests that come out on Friday. But believe me, there's a rot deep in that system. Sooner we think this will change and we'll roll over, and the dollar will rally again against the euro. Whether it goes to 135, 131, who knows? But we think we're getting close to a turn here again in the euro. So let's take a look at this. This is the U.S. dollar index. The red line is the 200-day moving average, and we just threw some retracement numbers up on here. This was the move. This high here, back here, and let me grab the pen again. Let me grab the pencil and see if I can get a smaller line. There we go. This was the high, the credit crunch high in the U.S. dollar when it rallied up, came back. This was the retracement of that old low, which was about 82%. That old low was down in here somewhere, and everybody thought it was game over again. Bottomed here in December, rallied up, and now it's correcting in a big way. And if you follow some of the Elliott wave stuff, this looks like a standard and much-needed correction to correct this move here. Now, in terms of time, in terms of depth in here, we think this correction makes some sense, and we think we're getting close here, to the correction being over in the dollar. Whether it carries down in some, stronger chart support area, 81 level, back in here, or even test again its 200-day moving average, is surely a possibility given the sentiment now building towards the euro of late. But overall, we think this is a correction in the longer-term bull market in the dollar, shaking out some dollar bulls in a big way because it's a decent correction. And I don't think a lot of people expected this. A lot of people have built up the idea that the euro was going to disappear. It may disappear, but markets don't make it that easy for us. They shake people out, and I think this is part of that move. This is a look at the euro. Just the euro itself, euro-US dollar, a little closer in basis. This is the euro daily. And what we have charted on here is just what we think is an A, B, C standard correction in the euro. If you look at wave C from here to here, and we say wave C is 1.61 the length of wave A, which is kind of standard in an ABC correction, measuring from the bottom of wave B, it would take us to 131 level, so it's a target we're watching. We got the 130.28 today. You can see probably took out some nice stops here above the 130 level, came back down, and we're sitting in here kind of a nice spinning top here today of indecision. We'll see what Friday brings, and again, Friday's stress test. Most people now are not concerned about the stress test. They expect some whitewashing in here, so it should be interesting to see. Most people said, well, all the bad news was in the euro, but maybe with now the stress testing and all the good talk about the euro, maybe a lot of good news is back in the euro. We'll find out that pretty quickly. One of the things we're watching fairly closely, and this is an interesting chart if you follow gold at all. The black line, the black is gold, the red line is the euro, and this is that euro correction we just saw, on the chart here. This is this whole segment right here of the euro in red, and you notice the negative correlation and negative tight correlation that's developed between gold and the euro. Gold going higher, euro lower. We think that that's money, obviously, that's coming out of the Europe that wants to get into the U.S., but a lot of money doesn't necessarily want to go into the U.S. and wants another place to hide, and we think it's gold. So obviously this risk in the euro was part and parcel to both the dollar and gold moving in positive correlation, which it usually doesn't do. And sure enough, now gold and the dollar are moving in positive correlation, both down against the euro, which means gold and the euro are in negative correlation. Tested this trend line today and bounced up above it. I think when we had gold close today, let me look at that, Steve, real quick. We had gold close at 191, up $10 today. So gold came back above this trend line in here. Euro is down about 60 pips, 60 pips. So we're watching this as kind of a correlative indicator. So it's going to be interesting again Friday, and this is why we say we think we're getting close. We think if gold starts blasting off again, it says risk is coming back into the euro, and this correction may be over. So if you're looking at some indicators to watch, I think gold and the euro overlaid is going to be a good one. And as I said, this is why we think we may be getting close, or we may be getting close if gold just blows out here. The euro is going to rally a lot higher than we think, and our story is very much on hold. On risk, as you can see, our number one choice here really is the euro on this story. We think the euro has a long way to go. We're looking at par, and the euro ultimately has been our call for a while. But secondarily, if we get in the risk concern that, the China concern that holds China-Japanese parallel, if that starts to play out for some reason, and at the moment we have to say there's a low probability it will play out. I say this and just from experience, it's easy to go broke betting against China. They always seem to find a way to keep the music playing, and have done a fantastic job of that. So trying to forecast them getting in trouble is always tough. But what you can see here is this. What this shows, this is the Aussie-U.S. dollar pair, and this was the credit crunch move when the Aussie went from near par against the U.S. dollar all the way down to 60 cents. That was a massive move in just a couple months in the Aussie, and shows how the game can change very, very quickly for the commodity currencies that are so highly leveraged and have a massive premium in them precisely because of China's growth. And that's the case again with the Aussie.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.